Hello everyone, welcome to my channel. This is Easy Accounting Channel. Today we are talking on Register Retirement Savings Plan, RRSP. Let's define some of the terms in this savings plan. Advantage is any benefit or debt that is conditional on the existence of the RRSP, while income that has not been paid from the RRSP or RRIF within 90 days. Annuitants of an RRSP or RRIF is the person for whom the plan or fund provide retirement income for. Then arm length refer to relationship or transaction between person who act in their separate interest. Common law partner is the person you are living a conjugal relationship, while commutation payment is fixed or single lump sum payment from your RRSP annuity. Deferred profit sharing plan, DPSP, is an employer sponsor plan will register in which the employer share the profit of a business with all the employee. Then defined benefit provision, the term of an RPP that promises certain level of pension on retirement based on the employee earning. Then earned income, we calculate your earned income by adding your employment earning, self-employment earning, and other income. Fair market value is the question of fact, but is generally considered to mean the highest price expressed in terms of money. Financially dependent. If you have a child, grandchild, you are generally considered to financially dependent on the annuity. Then your net income for the previous year was less than the basic personal amount, or you are an infirm, or your net income for the previous year. Let's talk about foreign plan. An arrangement maintained primarily to benefit non-resident for services they perform outside Canada. Matured RRSP is paying for your retirement income, money purchase provision, the term of an RPP under which the amount of your pension depends on how much you and your employer contributes to the RPP. Non-arm length refers to relationship or transaction between two person who are related in each other. The non-qualified investment is any property that is not qualified for the RRSP or for the RRIF trust. Pooled register pension plan, a retirement savings plan to which you or your employer both contributed. Then prohibited investment, that is the property to which RRSP or RRIF is closed connected. Qualified investment and investment in property, it could be money, governments, bonds, corporate bonds, mutual fund, security on the stock exchange markets. Then qualified group plan is referred to as mandatory group plan. It's an arrangement, a qualifying arrangement if all of the following applies. That is for two or more individuals, and the contribution are amounts you are entitled for services you provided. Then qualified retirement plan for the purpose of Canada and US, a US qualified retirement plan is a plan that is generally exempt from income tax in the United States. So registered disability savings plan, RDSP, a trust arrangement between an individual, a trust company in Canada. Registered education savings plan has a registered contract between an individual and a person or organization. Registered pension plan, RPP, is a pension plan that we have registered fund. The registered plan strive the amount of a reduction in the fair market value of the property of the RRSP or RRIF. The Registered Retirement Income Fund, a fund that is established with a carrier that will register. You can transfer the property to the carrier from RRSP, RPP, RPP, or SPP. Registered Retirement Savings Plan. A registered retirement savings plan that you establish, that you register, to which you or your spouse contributes to the plan. Related person are not considered to deal with other at arm's length. Then RRSP contribution is the amount of cash or kind that you contribute to your RRSP plan. Then RRSP deduction is the amount that is indicated on your income tax line 20800. Then the RRSP deduction limit, the maximum amount you can deduct from your contribution you made to RRSP or PRPP or SPP, or to your spouse or your partner RRSP. The RRSP limit is the maximum amount of new RRSP deduction room that you can create for a year. Then RRSP excess contribution, the amount of your RRSP or PRPP or SP contribution that is more than your RRSP contribution limit for the year, plus 2,000. So if you have RRSP excess contribution, you may have to pay tax of 1% based on the excess on that contribution. Specified non-qualified investment income, income or capital gain that is reasonable, attributable directly or indirectly to an amount that is taxable for any RRSP or RRIF. Then specified retirement arrangement, a pension plan that we do not register for income tax purposes, and that is either not funded or partly funded. Then spouse or common law RRSP is RRSP that you establish to pay yourself income at maturity that you or your spouse contribute to. Also an RRSP that received amount or transfer from any of your spouse or common law RRSP. Then let's say swapped transaction. This is any transfer of property between RRSP or RRIF, and it turns to exception are provided for contribution to and distribution from the plan. Then let's talk about traditional prohibited investment benefit. This expression is relevant only if an individual held one or more prohibited investments in their RRSP or RRIF on March 23rd, 2011. So they continue to hold the investment in their RRSP or RRIF in that tax year. Then unmatured RRSP, generally referred to as not yet started to pay your retirement income. Unrelated person may not be dealing with each other at arm's length. That unused RRSP or PRP or SPP contribution is the amount of your RRSP, PRPP, and SP contribution that you could not deduct or have not chosen to deduct, and you did not designate as an HBP or LLB repayment for that year. So unused RRSP deduction rule at the end of the year. Thank you for coming to my channel. I hope to see you in my next video. Please subscribe to my channel and share my video. Thank you. Bye.